For thousands of small Indian businesses, exporting is not about demand alone. It's about money, how expensive it is to borrow, and whether banks are even willing to lend. Government data show that India's micro, small, and medium enterprises (MSME) sector accounted for nearly 50% of total exports before the pandemic in FY20, dipped through FY22 and FY23, and then recovered to about 45.7% in FY24. Latest figures indicate that shares rose to 48.55% in FY25, underscoring the continuing importance of smaller businesses in India's export story. For MSME exporters, high interest rate and lack of collateral often become the biggest barriers to going global. To address this, the government has launched new export credit support under its export promotion mission approved by the Union Cabinet in November 25 with an outlay of over rupees 25,000 crore till FY 2030 to 31. The focus is clear: make export finance cheaper and easier for MSMEs. The first intervention is about lowering interest costs. The government will provide an interest subsidy of 2.75% for export loans, both before goods are shipped and after shipment until payment is received. This directly reduces the cost of borrowing for small exporters. The second move tackles another big hurdle: collateral. Many MSMEs don't have assets to pledge. Under the new scheme, the government will guarantee a large part of export loans, making banks more comfortable lending. Guarantee cover goes up to 85% for micro and small enterprises and up to 65% for medium enterprises and up to rupees 10 crore per exporter per year. To understand what this policy means on the ground, we spoke to MSME exporters about the challenges they face in accessing export credit and managing interest costs.
The cost of fund for the investment for making exportable garments is very high compared to our competing countries across the globe. So this was the concern, and thereby it was well explained to the concerned ministries of Government of India, and thereby the interest subvention scheme has been introduced, wherein the MSMEs have been given up to 3 to 5%, earlier 5%, and then it was reduced to 3%. And now, after a gap of almost a year, now they are invoking 2.7% support to the MSMEs. Because otherwise, our global competition edge will get blunt, because the competitors are having a much advantageous the cost of fund aspect support. The government have come forward and given 2.75% interest subvention and fixing a cap of 50 lakhs per unit. So, which is again, it is insufficient, we would say. But anyhow, this support is a welcomeable one.
Generally, banks takes 10 to 15 days for getting things organized. If that delay is further reduced, then definitely it will be a big game changer, because number of days is what is the problem that the MSME is facing. And even after going to the bank and they even again delay, then that will be an issue. No collateral is fantastic. That will be a big help, because already our collateral will be already used in the bank. And if we can get a no collateral just based on export, because already the MSME have put their effort, they have purchased the material, they finished the job, and payment they are waiting. At that time, if they are able to come out with a no collateral, that will be a great game changer, and that will really help. Only thing is, the bank has to come out and do things faster. That will be a big help for the MSME.
This support comes at a time where global trade remains uncertain and the rupee has been volatile. In 2025, news reports showed that rupee weakening sharply due to global trade pressures. While a weaker rupee helps exporters, it also raises the cost of imports for raw materials. For MSMEs, this makes stable and affordable credit even more important. Both schemes will start as pilot programs with guidelines to be issued by the Reserve Bank of India and Credit Guarantee Fund Trust for Micro and Small Enterprises (CGTMSE). The government says the goal is to expand bank lending, reduce export costs, and help MSMEs compete globally. We also asked the exporters whether this new scheme will actually make exporting easier for them or if they feel more support is still needed.
We expecting from government a subsidy equivalent to the differential amount in comparison with our competitors. So for Bangladesh, say Bangladesh, Vietnam, Cambodia, we're averaging out that difference between our competitors and India. It has to be taken as a mean value, and that mean value need to be given as a subsidy. So then only we can retain the buyers, because now it's time is getting delayed. Almost 5 months is over. Now the existing buyers from the US market is not interested to place order with Indian suppliers. So this is a very dangerous situation, because once we lose the buyer, it will it will be equal to closing the opportunities for the country and for the entities, separate entities. So this has to be understood, because otherwise this is the subsidy, whatever EPM routed subsidy and all become null and void automatically, because of there is no businesses happening in future. So this is the very critical situation right now industry is facing. So we are all looking at the government of India only to come forward to handhold the existing MSMEs, not to get perished because of this geopolitical situation.
MSME, many times they don't know what are the schemes that are coming. So if the government is coming to associations and industry bodies, we can take it to the industry, so that many times schemes come, but the actual owner will not know that there is a scheme like this happening. So awareness is something that will be very important.
For MSME exporters, access to credit often decides whether an order ships or stays on paper. The success of this export credit push will now depend on how quickly banks adopt it and how easily small businesses can access the benefits.